Hello and welcome to this week's Australian Stock Market Report. Now this week we're going to look at why graphite might be the next big thing. Then we'll get into the Australian stock market so I can share with you my thoughts on where it's heading, along with answering your questions and looking at stocks for you. I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now before we move on, thank you for showing your support for our channel and hitting that subscribe button. Now remember, as you subscribe, click the bell on the right of it so you keep up to date with our latest videos. Also remember to tune into our live Australian stock market show, which is on every Tuesday, 7 to 8 p.m. Australian Eastern Time. Now this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. There has been a lot of talk about climate change with the recent climate summit, and it has been suggested that part of the way forward is to phase out internal combustion engines because electric vehicles are supposedly the way of the future. Indeed, over the last decade there's been huge advancements in battery technology, with lithium-ion batteries the choice for electric vehicle production. Now the demand for electric vehicles and the batteries that power them has sent lithium and lithium stocks soaring, with the demand for electric vehicles expected to rise dramatically over the next decade. Now another mineral that is less talked about but just as essential to lithium-ion battery production is graphite. Now this mineral is currently in phones, cameras, laptops, to name a few, as it is the anode material in the lithium-ion battery that contains graphite. Now one Australian company set to take advantage of the growth in electric vehicles is Evolution Energy Minerals, with the ASX ticker code EV1. And it listed on the ASX last week after a successful $22 million capital raising. Investors purchased the stock in EV1 at 20 cents, and after listing on the 16th of November, it traded at 58 cents before rising to 70 cents, or a 250% gain for those who invested in the IPO. However, by Friday it had traded down to 47 cents, only to close the week at 50 cents, or a 27% drop in price from the week's high, which is not really surprising given it was an IPO. It's not unusual to see a lot of excitement with IPOs where investors attempt to stagger profit by purchasing the stock with the intent of selling it for a large profit in the first few days of listing. As such, now is not the time to get into this stock, as there is high probability it will continue to fall away, at least in the short term. That said, I suggest you keep watching this stock and the graphite and lithium space for opportunities in the future. Now before we get into taking a look at the charts, remember, if you want to understand the stock market and have more control over your trading, then you can get a copy of my first book, How to Beat the Managed Funds by 20%, for free. All you have to do is pay the shipping. So get your copy, visit our website wealthwithin.com.au, or just give us a call on 1300 858 272. Now it's time we take a look at what happened in the market. So let's start with what were the worst and best performing sectors last week. Now the best performing sectors included information technology up 3.05%, followed by healthcare up 2.94%, and communication services was up 1.85% last week. Now the worst performing sectors include financials, and that was down 3.57%, followed by materials down 1.65%, and energy, that was down 1.53%. The best performers in the S&P ASX Top 100 stocks included Crown Resorts. That was up 18%, Altium was up 9.57%, and NextDC was up 8.47% last week. The worst performing stocks included CBA, and that was down 9.54%, followed by ALS, and that was down 7.74%, and Bank of Queensland was down 5.35%. So what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks that you've chosen for me. Well, again, it was another interesting week on our stock market last week. The market was up on a Monday, making a new high that we haven't seen since, I think, around early September. But I'll show you that anyway when we get onto the charts. But then it spent some time going down, and the indecision that we seem to be having over the last couple of months is continuing on. But let's go and have a look at the charts right now. And as normal, on the left is the monthly chart and on the right is a weekly chart. And this is not my normal workbook. I've had to get a new laptop at the moment and send my old one off to get fixed. But so I put some of the things that I had on that other chart that you're normally used to seeing on these reports. Now, again, really this whole long-term momentum that we've had since the GFC low there in March 2009, it's really sort of continuing. And the market is really sort of struggling to get above it. You can see here, if I really go up, zoom it right up, it's closed above it here back in July and then in August, but then it's really behind it at the moment. And currently here in November, we're closing at 7729, which is pretty much right where the grey line is running through there. Now, we didn't come down as much as what I had hoped or what I had originally thought through there in back into September. I really did hope our market was going to come back a little bit further, which basically suggests that if we didn't do that, then the run up might be nice and sharp there. So right now, what I've been thinking a little bit more recently is our market would move up, make a new all-time high closer to Christmas into January, possibly into February, and then come back down into another low. But currently the trading we're seeing here at the moment is, if we go back here to July, the market closed at 7664. And currently, as I showed you just then, it's currently closing at 7729. So not a big difference there. So if I use my little tool here, you can see here that sort of between here and here, there's like less than 1% movement in that period of time. That's what I'm saying, in the market's generally going sideways and has been going sideways over the last sort of roughly 4 months, even a bit longer than that. If I go back to June at 7585 points, the market closed at. So it is pretty close there and we're not getting too far. And this is just showing that the bigger, broader range of the market, or the broader psychology of the market, is we're not in a bullish type of environment. Therefore, we're not seeing prices push through. Now, you need to remember that most amount of trading on any market, or specifically ours and also in the US, is the biggest traders are the big institutions, the big financial institutions, the broking houses, etc. And they're the ones determining what these stocks actually, or the markets actually do, because they're trading. I know in Australia it's around 70% of the trading is done by these big institutions. So the 30% is really done by normal people, if that makes sense, or the average Australian. So we're seeing this not pushing through, which means the big end of town are not supporting a bullish sort of outlook for the market. Now, if we go down to the weekly chart and have a little bit of a look here, you can see really what's been going on. Now, this high here is back pre-COVID high. That was that February 2020 high there at 7289. To that recent high that we saw back there in August, we're only 8.34%. But you can see here it's just really been going sideways. And if you go back to June there, we're really not covering too much base. Now, interesting here, what we're seeing is this general sort of move up, but not getting anywhere. We've hardly gone anywhere since October. So a whole month we've been in this sideways move, down, up, down, up. But interestingly, this week, and I'll show you this week, you can see here, there we had Monday, or last week, sorry, Monday was up. We made a new high, and that was the highest high we'd had since way back there in early September through here. And then two big bars down. Thursday, we closed up slightly. Friday, we closed up slightly there. But you're still, really, this fall from Monday down to there, if I use my little tool here and put it on the top there and put it on the bottom there, that point there, that 1.67%, is about halfway in the distance. It really hasn't been able to move back up again. We do really need to see it move that back through that over this next few days. If it's not going to do that, then we may see this market start to fold over and start to move down through until maybe January, even in February. So the two things that can happen right now, if I go back to the weekly chart, is we may see something like this. And if I use my little trend, my little arrow tool, wherever it is, no, it's not there. I'm trying to find it. No, that's not it. I'll find it through here. Nope. Get on the right one. Drawing, there it is, that's the one I want. So what we might see is one or two things are going to happen. We're going to see this down into sort of January, maybe into February, and really I don't think it's going to be a big move down if it does move down. Don't look at the depth of that move down, but that could be the move down into January or late January, even into February, possibly March. I don't think March. The other thing that could actually happen is we see something like this, maybe a tiny little bit of down, and then move up into January, February, March, and breaking through the previous all-time high, etc., doing all of that really, really nicely. And at this point in time, you've got to start thinking is because we're being that sideways movement there, that the movement's probably going to get down unless we get some really good news on the marketplace and the big end of town start to push this market. We won't get anywhere. But really, if it does fall down, it's probably only going to be a 5% move, maybe a little bit more. And I'll use my little tool here from where it's closed at this point in time. If you go down to 5%, it's really down to about 7,300. If we go down to sort of around about here, about 8% is about 7,000 points. So I'd say any move down would be contained within all of that. But then the market is surprising, so you never know what's going to happen. But so they're the two things that could happen. If this happens and the market moves through to new all-time high, then you've got nothing to worry about, and you don't need to really doom much if you've got stocks. But if it does this, you may need to look at exiting some of your positions if stop losses are triggered. That's if you're more short to medium term. If you're more longer term, then you might just ride out this, because I think next year, 2022, our market will be a little bit more bullish. One of the things I wanted to share with you, a couple of little things, and this is the size indices. This is the different indices within the Australian market. So we've got, or the sectors, sorry, not the size indices, that's the size indices there. So this is just showing last week what all the different size indices did, like the ASX 300 was down 0.6, the ASX 200 down 0.62. I look at these to see what's moving, and you can see the ASX 20, which is the top 20 stocks in the market, were down 1.74%, where the mid-cap 50 was up 1.7, and the small ordinaries up was 0.4. So people are going for those mid-caps and smaller ordinaries to find profit, not necessarily at the big caps. The big caps are the ones driving the market. And I want to show you the sector indices. And this is really important because we can see information technology last week was up 3% and healthcare up 2.9%, as I mentioned earlier in my report, and communication services up 1.85%. But look at this. The three sectors, the two biggest sectors in our market, materials and financials, which I again mentioned a little bit earlier in the report, they were the weakest, along with energy. Now you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there's 10 of these, 3 of them were down, 7 were up, and yet the market, if I go back to the size indices, the market was down 0.5%. So what's happening when you look at this is these sectors are driving the market. If information technology and healthcare is a reasonable size section, but if some of these stocks in here sort of ease off a bit and we continue to see materials and financials have weakness, then the market will fall over. But this just shows you the power of these two sectors, that it can pull the market down when 7 other sectors are up. And it can pull that market down. So just look at this, and again, we'll just have a quickly look at the top 20. Sorry, these are your top 20 stocks, and I'll just make this a little bit bigger so you can actually see it. So you can see all the stocks, but you can see here what's been going on with these stocks. This is again last week, so here's a few stocks here that are in the green. Goodman, Macquarie, CSL, Scentre Group, Telstra was up, Woolworths, IAG, all in the top 20 stocks. But look at this. Combank down 9.54, the biggest bank in Australia. NAB down 4, ANZ down 3, BHP. They are biggest stocks in our market. 1, 2, 3, 4 stocks, all quite bearish for last week. So it remains to be seen whether that's going to continue on or whether they're just going to ease off and then go back up again. And that's possible. As I said, right now there's 2 scenarios, and there's always 2 scenarios. The market's either going to go up or going down. What the important thing is that you have a plan for whatever happens. As I said, if the market does go up into January and February, make a new all-time high, you've got nothing to worry about, so don't worry about that. Always worry about, or always plan for, what if it does go down? What am I going to do? If Combank continues to fall away more than 9%, let's say it falls away another 9% over this week, what are you going to do? I'm not saying it's going to do that, but I'm just saying, what are you going to do? What's your plan? Are you going to hold or are you going to exit? And how are you going to do that, and how are you going to determine that? And this is really what Janine and I constantly talk about, is knowing what to do and having rules around it is so much better for you, but better for your returns, better for your sleep, etc., etc., etc. So by understanding that and just having some simple rules around it. Now, I know a lot of people watching our videos don't think that they could trade the market or do the analysis that we're talking about or showing people, and we only show really high level stuff here, but anybody can do this. I seriously, we're teaching a 14-year-old child at the moment who's doing our diploma course. He's learning literacy and numeracy tested to prove that he could actually study, but a 14-year-old is doing our course. I reckon you could do it too if you wanted to really understand the market and learn how to profit from it. But that's it for my market report for today. And let's go into the questions that you have for me. Now the first question we have today is from S. Lee, who says, what do you think about IAG for medium to longer term? In the short term, what do you think will be the support level? Thank you. And let's get into it. Now, obviously you're asking me medium to longer term, so the short term is not really relevant here, and I'm not sure why you would ask about the short term from that point of view, but right now it is going down, and if we look at that monthly chart, and you can see that it is going down, it's quite heavily going down over the last few weeks and few months. This could be just a pause before it further falls. Right now, I'm not excited about this stock at all. I think at this point in time, it is possible to find some support through here, but that around that sort of 424, but I think it's likely to break below it and go lower. I think that's what's likely to see here from what I'm seeing on this pattern. We may see a little bit of a bounce up again, but again, medium to longer term, I don't really like it at the moment. I think longer term, yeah, probably. But I'm not a huge fan of insurance companies, and this week we've got two of them here because you do see volatility in some of these companies. But again, it's not a buy and hold stock. You could have bought it around the same price way back there in 2004 as you would here. But if you buy it at the right time, for example, if you bought it in this run-up, you would have made some really good money. If I show you here in my price range percentage, if you just go down to there to here, look at that, 109% through here. And from there through to here, it's roughly another 80, up to that one, that's an 80-90%. So you can get some really good returns out of them when you do get them on the uptrend and the up move. But as far as buy and hold, these are not really the stocks you would be buying and holding. There's 204%. So if it does come down a little bit further, that could just spell a much better opportunity for you. But at this point in time, I wouldn't be in IAG. I'd be staying right out of it and waiting for it to prove it's starting to go up. So short term, it may bounce short term, I don't know, but that $4 mark is pretty important for it. But my suggestion is what I'm looking at right now at this point in time is it's probably got a little bit further to go. But again, like I constantly say, it doesn't matter what I think. What I'm thinking right now is really about what I'm seeing on the chart today. Next week or tomorrow or next month, I might see more data that might suggest that it's going to be better medium to longer term. And that's what it happens because we get more announcements, more trading, more everything's happening. And so therefore we can maybe make a different assumption on it. But what I'm seeing right now is this is probably not a stock I want to put my money in. But thank you for asking the question. Now we've got a question from Kane who says, hi Dale, would appreciate if you could have a look at QBE insurance. Don't currently own, however, thinking of entering, traditionally always been skeptical of insurance companies. How will inflation impact the share, do you think? Thanks, Kane. I'm with you, Kane. I'm not a insurance person. I've traded QBE and make good money out of it a few times, but I'm generally not a fan of insurance companies. I'm pretty much stay out of it. I think QBE is the only one I've really traded. I don't really trade the rest of them because things happen, natural events, disasters happen, all sorts of things that may affect insurance companies. I also don't buy airlines. I've never owned Qantas for myself either, because things happen with airlines and can see their price fall really quickly. And yeah, they can get some really good returns on the upside like I've just showed you on IAG, and QBE does exactly the same thing. But let's go and have a look at QBE now anyway. QBE has constantly been disappointing us over the last few years. It just constantly, you can see the volatility of this stock, but look at this. This is your monthly chart, but look how far it's fallen since this previous high back in 2007. It fell away 79.35%. But every time it looked like it was starting to go up and had a lot of strong support around that sort of $9, $10, every time it moved up, it came back down again, and recently here through there, that COVID low went down to $7.13. But again, you could have bought QBE way back through here. Now, I traded QBE through all of this, and that was a beautiful run, and I traded QBE through here, and it was a great stock to own through here. But again, it's not a stock that you buy and hold like most insurance companies, and pre through here, it was really nice. But right at this point in time, it is looking a lot better. I do say it is looking much better, but it's got a lot of resistance around that $13, $14 mark, as you can see. A lot of resistance around there. So is this move here just another one of these before it falls away? Not 100% sure, but I think right now my money wouldn't be going into QB until it gets sort of way past that sort of $15 odd mark and really gets a bit of blue sky there. If you can do that, then I'd be quite happy with it. But at this point in time, I'm really going to err on the cautious side with QB, because it's like AMP. It's been doing the same thing. It gives so many false signals, AMP. But in AMP, it's risen 100%, just like I've shown you IAG did. BHP, sorry, not BHP, QBE. has also risen 100% plus in those times that you've seen on the chart. So whilst they can get some great gains out of insurance companies, they are more trading stocks. They're not stocks that you just buy and hold and forget about and go, okay, these should be good. They're big stocks. QB is a really big stock. So is IAG is a big stock. So is AMP is a big stock. But we really do need to be careful about why we're buying them. And also, if you are going to buy them, it is imperative and not just a nice to have. It is imperative you have a good exit strategy, because otherwise you'll get caught in the downward runs when they do have them. But thank you very much for looking at that. So right now, if you are enjoying the show, can you give us a really big thumbs up there? So it only takes 2 seconds to click that button, so give us a thumbs up now. Now, the next question we have is from Adam, who says, hey, Dale, would love to hear your thoughts on Westpac. Bought them back in February this year and they have had a rough patch recently. Thanks for all the weekly updates. Now, financials have done really, really well this year. They're up over 25% for the year, so you can understand why people bought them. But a lot of that was actually CommBank. And if we go and have a look at Westpac, which is a stock that is a bit bearish at the moment, and that's what he's talking about. But on the screen you can see the monthly chart of Westpac. You can see here how bearish it's been since this high back in April 2015, and like the banks, all the big four banks, March, April 2015 were their highs, and moved down 66.2%. Now, Janine and I did a show on the banks, our live show on the banks. I'm not sure it was last week or the week before, but in the last couple of weeks. So that gave you our thoughts on all of the banks and what we thought. And Westpac right now, that's really interesting. And if you look at it, just use your here's the trend line tool. If I go from that high there, just on a monthly chart, and look, you can see there's a lot of resistance across that sort of level for Westpac, and it's not breaking through it at the moment, and it dropped away. So wouldn't surprise me if it's got a little bit further to fall. I mean, it had a big move through here, which is where you bought it somewhere, and it does move quite nicely when you find it. So there's that March 2020 low right up to there. So it made 100%. So I'm not I understand why you might have bought it, but at this point in time, I can't see. You should be looking at using an exit strategy on there. There's some reasons why I wouldn't own this stock right now. But as opposed, CommBank is a great stock. It's fallen away last week 9%. But it and Macquarie Bank have been the best two banks to own over the last year or so. And not discounting Westpac, but I don't think the longer term move on Westpac is as great. But go and have a look at the recording that Janine and I did a couple of weeks ago, I think last week or the week before, which we did for our live show, which is on our YouTube channel. So just go and have a look at that, but it'll tell you a lot more about what we think with all the big four banks, not just Westpac, but CommBank and also NAB and ANZ, and what we think. And I think there's possibly some better opportunities for you. But again, as I said just a minute ago, make sure you have an exit strategy on this stock, because if you have a long-term view on Westpac, I think long-term it should be fantastic stock to own, but short-term, maybe a little bit more weakness. But thank you for sending in your questions, and thanks for everyone for sending in your questions. We really do appreciate it, as others do who watch this recording each and every week. A lot of you sit back and say, wow, I love what you're doing. I love you answering the questions and looking at the stocks, Dale. I get a lot of emails like that. But if you have any questions that you'd like me to answer, remember, first thing you need to do is publicly subscribe to the channel, because this means I will actually answer your questions if you publicly subscribe to the channel. But, you know, we also need your support for the channel, so that means we need you to hit that subscribe button too, so that other people can find it. So if you do have a question, just, as I said, publicly subscribe to the channel, stick your comments below in the comment sections, and we'll get to answering them next week. Now also remember that here on this channel, we do these market reports each and every week on a Monday. We also do our live stream with Janine and I on Tuesday night, 7 to 8 p.m. So I look forward to seeing you tomorrow night right here on YouTube for our live show. Remember, hit the subscribe button now, click the bell on the right of it so you know when we upload and go live with our videos. That's it for me from today. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.